It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, national underwriter for Old Capital. Smartest guy in the room. Actually, we have two smartest guys in the room today. Unbelievable. On our special Ask Mike Mondays, we have the man himself, Mr. Michael Becker. Michael, how are you?
Hey, Paul, how are you?
Doing great. Second smartest guy, the professor himself, Mr. James Eng. James, how are you?
Good. Thanks for having me. Special edition.
Special edition. And the reason why it's special edition is that for people that have not seen interest rates rise in their lifetime, their professional lifetime, in the last, say, 10 or 12 years, we're starting to see interest rates rise. And so for the last 20 years ago, they were higher, then they came down, and they really started to come all the way down. But now we've seen a little bit of an inflection point that things are starting to rise significantly on interest rates. So in the last week or so, we saw interest rates rise by 0.25%. So our conversation today really is where everybody kind of has an idea of what's going to happen with interest rates, but we have an operator in Michael, and we have the professor in James, and kind of talk a little bit more about what's going on and what kind of an impact that's going to see with interest rates rising. So again, the topic of the conversation today with Ask Mike Mondays is, Michael, what do you think about what's going on with interest rates going up by 0.25%?
Yeah, there's a lot of, I don't know what the hell to think, Paul. It's it's choppy. You've seen rates rise. You've seen spreads kind of widen out. So your all-in interest rate that you're paying is certainly increased quite a bit over the last, 3 to 6 months, and last really year to date, 2022 in particular. So certainly you haven't seen pricing come in. You've seen pricing accelerate. So we're seeing prices go up, you're seeing interest rates go up. So you're basically seeing returns go way down. I think that's essentially kind of what's happening. So there's got to be at some point some inflection one way or another. I mean, thank goodness we have dramatic rental rate increases from an investor's standpoint. So you're still seeing reasonable returns because you're projecting these higher rates. And at the same time, if you're thinking that interest rates go up, it affects everything. So it's also impacting the single family side and affordability within the single family space. And you're seeing very limited inventory. So you're again seeing, home prices go up and interest rates go up, which makes your mortgage payment go up, which makes home ownership even less affordable, which drives more people or keeps more people in the rental pool. So that should, in theory, support higher rental rates. So I think it's confusing, to be honest with you. There's a lot of stuff going. It's conflicting.
Yeah, let's talk a little bit about the history of the last couple of years of interest rates and where they've been. And we can talk a little bit about that, but I think people's eyelids will start to get glazed over and they just want to understand that. And so let's just talk about the last week or so, because SOFR is kind of the new LIBOR index, and that kind of affects short-term interest rates. And we've seen it go up from 0.05 to 0.30. And that doesn't sound like a lot. But James, talk a little bit about where we think interest rates are going to go on a short-term basis in the future.
Yeah, it was one of those things like they kept saying that they're going to raise the rates, we're going to raise the rates, we're going to raise the rates. That's all we've heard for like the last 6 months, but not until really last week did people say, oh man, they actually did raise it. So not only did they say, hey, we're going to raise it 25 basis points at this meeting, we're going to raise it 5 or 6 more times, and it might be 25 basis points, it might be 50 basis points. And so all of a sudden, you might look up March of 2023, and it might be 1.5%, 2% on your SOFR rate. And so that is your base rate on all these floating rate loans. So, whether you did a Fannie, Freddie floater, or you did a bridge loan, 95% of these were floating rate. And so all of a sudden, you add a 2% SOFR plus your spread, you might be looking at a 5.5 interest rate because your loan monthly payment is reset monthly. So all of a sudden you thought you started at 3 and now you're at a 5 all of a sudden. So the Fed is trying to do this to combat inflation. So inflation is bothering everybody. And so whether you go to the gas tank or you're filling up your gas tank or buying a used car or buying anything right now, it's more expensive. And so the Fed is really trying to control the front end of the curve. And by signaling that they're going to keep raising rates, basically the 2-year treasury has gone from like 10 basis points to, 150 or 2 really quick. And that's getting a lot of people nervous about sort of an inverted yield curve at this point.
Let's talk a little bit about rates themselves, because we have fixed rates and then we have adjustable rates. And so where are the adjustable rates right now, James, and where are the fixed rates right now? And let's just use a $10 million loan on a multifamily property. Give me kind of an idea where rates are.
Yes. I mean, if you end up doing like, let's say a Fannie or Freddie floater, then their spreads are maybe 300 over SOFR, let's say. So if SOFR is 30 basis points, you'd be 3.3 starting rate. But most of the bridge loans that people are using on acquisitions on floating rate are typically 350 to 450 over SOFR. So your starting rate now is closer to 4 to 4.5. On the fixed rate side, with 10-year Treasury moving up, you're probably closer to 425 to 4.5 right now on the fixed rate side.
So what that really means is that within the fixed rate itself, there is like an embedded interest rate cap or so. And so you don't have to buy an interest rate cap when you do a fixed rate, but you do typically have to buy an interest rate cap on an adjustable rate. Is that true, James?
Yeah. So typically they're wanting you to hedge your risk a little bit. And so in the past, these interest rate caps, they might tell you, hey, we want you to cap SOFR at 1.5% or 2% or 2.5%, wherever your debt service usually hit about 1.0. And so those, interest rate caps, they might be 50,000, 100,000. But as these forecasts for the forward curve keep increasing, essentially these interest rate caps are doubling or tripling in price. So we had one that was 100,000 in December, and now in March it was 300,000. So they're moving up quick in price.
What type of an impact does that have, James, on a deal where one of the components that you have to be mandatory to buy this interest rate cap, this protection in case interest rates go up, and you have a strike price, which means that if it goes higher than that, you're protected. But if it is at that or lower, you have to pay. It's going to go up. So what kind of a financial impact has that had just recently on some folks?
Well, for one, I mean, you have to bring more money to close these deals. And so that was a 20 million plus deal and, 300,000. So you're looking at 1.5%. And so on a lot of these deals, what's my other option? My other option is I do a fixed rate deal and I have yield maintenance. And so you can pay 5-10% of your loan amount in a prepayment 3 or 4 years from now, or you can pay this interest rate cap and you get a floating rate and you mitigate that risk every year. Mike can talk a little bit about floating rate in terms of escrowing for some of these interest rate caps, though. But that's something I think newer syndicators have not dealt with. Even Fannie Mae and Freddie Mac, they're going to start coming back to you for more money on these interest rate caps as they go up in price.
Let's talk with an operator, with Michael Becker and SPI. Michael, tell me a little bit. Again, you're a former banker and you've seen all this type of stuff in the past with interest rates that have risen or gone down. And so you kind of used to some volatility, but what type of an impact has interest rate caps had on you and your group and the cost of the debt service, let's say, moving up?
Yeah, I mean, I think as we kind of get into a rising interest rate environment, usually these caps. So if you took some floating rate mortgages, a lot of the agencies, certainly the Freddie Mac floating rate ARM product was very popular the last few years. We've done a bunch of them. So it's a 10-year loan. And then on the front end, they typically make you buy a 3-year cap, which was most typical. And so, we bought some caps and then the cap, like James said, would have a strike kind of in the mid twos, probably if it was originated in the last couple of years. So if LIBOR went up, the strike, that's when the cap would kick in. And the cap was reasonably inexpensive. So, you're paying 25 to 50 basis points for that 3-year cap a few years ago. And now it's, 150 to 200 basis points maybe of the loan amount. And so that's certainly patchy on the front end. Well, then kind of fast forward a few years, all these loans that we all put on these Freddie floaters, I'll just kind of read you a letter and I'll kind of check the names, remove the names, check the innocent. But I just got this letter the other day in the mail. It said, "Dear Michael, as servicer above referenced loan, the bank is requiring the loan documents acquired by the loan documents to analyze the interest rate cap reserve semi-annually. As a result of the most recent analysis, the monthly payment will increase from $657 to $9,604 beginning with your 4/1 payment. If you have any questions, please contact me at this." So basically, we're saying we're going from $657 in my monthly impound to $9,600. So like 15x or something like that.
Wow.
Yeah. And so our cap will be up in about a year. So what they're doing is maybe repricing the cap today and what it was going to take to buy a new cap in a few years. So that's, pretty material. So if you don't have some liquidity set aside for that, this is going to be a problem, right? So if you guys are distributing based off of what your current impound is, and you have an adjustable rate, Freddie floater, the letter similar to this is coming to the mailbox near you in the not too distant future. So I think this is kind of my public service announcement. If you have a Freddie floater or something with a cap that you have to rebuy here in the next year or two, you need to start preparing for a materially higher cap and impound and probably pull back your distributions or set aside some working capital for it, because it's going to be a problem if you have to buy that cap.
Well, let me make sure I understand it. So you took out a 10-year loan that was based on an adjustable rate, and Freddie Mac forced you or wanted you to buy an interest rate cap, which is like an insurance policy. So in case interest rates were ever to go up, that this insurance would kind of cover your butt. But you held it for 3 years, or you're going to hold it for 3 years. Then you got to buy it again for another 3 years. And then you got to go again for another 3 years. Let's say that you continue to be in that loan or until that period of time, whether you either sell that property or refinance that loan.
Yep.
So right now, is that you're into it for 2 years or so? And now,
so probably 18 to 20 months into it.
Okay.
And then here we are, we have another, it's probably our 18 months because it's semi-annual. So this is probably done at the 18th month. And so we have been in it for 18 months where they did this analysis. I had 18 months to go before my cap expires, and they're going to increase my impound by 15x. Because the first 18 months we're escrowing way too little. So we got to not only get caught up to what today is, we got to play catch up for the 18 months I have been impounding at a way short, a huge shortfall essentially.
Now what happens? Let's just say you guys start to put in this $15,000 a month to this cap, and they're not buying it until the month before or 2 months before, or the day that this interest rate cap that you currently own expires. Is that right?
Correct. Yeah. So they're just escrowing for 18 months in the forward when the cap expires, and we got to replace it with a new cap.
And so if you start multiplying that by the number of properties that you own that have this type of a floater on there through Freddie Mac or even Fannie Mae and these type of loans, this could be a substantial hit to your cash flow and for your distribution.
Plus you have your rates going up at the same time. So, our you were saying LIBOR SOFR went from 5 bips to 30 bips. And, the strike doesn't kick in to probably 250 bips. So then we're going to have another 200 basis points of rate that we got to eat before the cap kicks in to give you protection. So you're going to also have a use of cash every month by your increasing interest and increasing debt service, essentially. So, I'm not trying to scare anybody. I'm still team float, because James said that prepay if you fix it, might cost you 5 or 10%. Try like 20 or 25%. I wish you would have paid 5 or 10% and some yield maintenance on some of these deals we sold that turned out to be 20%. So I've seen the other end of it. So it's not a no-brainer just to fix if it comes to yield maintenance or defeasance, even in a rising interest rate environment. Because we've had our friend JP on here recently from Pinsford, and his whole thesis is that go back and look at the history. For the moment they start hiking, the Fed's on the clock to the interest rate cuts. And he thinks, 2 to 3 years and when we start cutting. So if you're fixing these rates today and then they'll be cutting in a few years, you could be shooting yourself in the foot by taking a higher fixed rate mortgage. And then you want to get out of it. And then you're trapped in this deal and have 20% yield maintenance or something to get out of it. So it's not an easy answer, but I'm just trying to give a public service announcement that these younger people, younger syndicators and experience, not necessarily age, if you haven't been through this cycle before, you're going to have some increasing interest expense. You have your escrow go up. You have to escrow for a new cap. Your tax ban's coming out in Texas here in a couple of weeks, so that's going to go up. And from what I'm hearing about my insurance renewal in May, that's not going to be very pretty either. So it was great. We're getting 15, 20% rent bumps, but we're going to start paying the piper on the expense side of the not too distant future. So you need to start budgeting for that and watch what you're distributing. You don't want to over distribute and have to try to claw some money back in the future.
I think that's really your public service announcement is don't go wacky to your distribution to your limited partners. At least right now, with everybody saying it, well, rents have been just jumping up as high as they have. And why don't you start to put more back to the limited partners? Well, let them listen to this podcast and then you'll have some ammunition for any feedback or fallback that you would have while you're not doing it. So that's Fannie Mae and Freddie Mac. James, kind of talk to me a little bit more about you guys over at Old Capital do a lot of bridge lending. Is that kind of similar to on the bridge piece? Walk us through just kind of a typical bridge transaction where the interest rates have gone from 5% up to 30 bips, 0.5 to 0.30, which is 25 basis points. What type of an impact is that going to have on the bridge loans currently being done?
Yeah, I mean, on bridge loans right now, typically it's a 3-year term plus 2 1-year extensions is your typical bridge. What they're seeing is spreads are still increasing a bit. So probably last year we saw probably 325 on most deals, and now it's going to 375 to 4 on most of these deals. Larger the deal, the higher, lower your interest rate will be. And then, since these are 3-year initial terms, most people were buying 3-year caps when it was $30,000. Not a big deal. But now, because these caps have gone out, there's only a couple things you can do to reduce the amount of your cap. One is, you can shorten the term up, right? So you can go to 2 years versus 3. You can increase your strike rate, and there's a couple things you can do. So, I mean,
talk about that strike, because I don't think a lot of people understand what that really means, what a strike price is when you put together an equation for an interest rate that's an adjustable rate.
Yeah. So let's say your strike rate, let's say you choose 1%. That's the max sort of SOFR rate that you're going to absorb as the investor. And then if it goes above that, then basically you're going to get a payment from your sort of quote insurance provider, whoever is the counterparty on that interest rate cap. But if your SOFR sits below that strike rate, then you're not getting anything, right? So you're going to get an email every day saying that you're not in the money. But if you're above 1%, let's say SOFR goes to 1.5, then you're going to get paid every month. But the problem is that most of these people buying caps right now, you're probably buying a cap at 2%. So if you look at a forward curve right now, these things seem to be moving faster than anything else. But a forward curve right now, pretty much what Mike was talking about, after they hike the rate and hike us into, let's say, a recession, the Fed says, all right, that's enough of that. Jerome Powell gets the memo that we don't need to be doing that anymore. So they hike us to 2%, maybe 2.5% on the SOFR, the Fed funds rate. And then, they'll probably start cutting back the rate here probably in 2 years or so.
Do the bridge lenders, so again, Fannie Mae and Freddie Mac, they require 3-year interest rate cap, interest rate hedge in the deal. Do the bridge lenders require 3 years? And you said something about just doing a 2-year interest rate cap and then having a year just to be exposed? Or what happens on year 3 if you've only bought a 2-year cap?
Yeah, so if you buy a 2-year cap, they're going to make you escrow for that 3rd year. And so they're going to go out and basically get that 3rd year priced out. And let's say I'm trying to make up numbers here, but let's say $100,000, they're going to take that divided by 24. And in the first 24 months, you're going to basically escrow for that 3rd year. And so I don't know if they check it semi-annually, but to start, they're going to do that. So you escrow for it. So I would say Fannie and Freddie are probably the most conservative, right? So they're going to do a 3-year cap and pretty much have you stuck at that number. Some bridge lenders have been more flexible and said, hey, you can do a 2-year cap. And then some bridge lenders are like, look, maybe we'll calculate what a 3-year cap is and we'll escrow for that. You don't actually have to go out and buy that cap. But if you need to pay this interest rate, guess what? You're going to pay it. So some borrowers are like, yep, I don't believe it's going to 2.5. Why am I going to spend $250,000? And some lenders are okay with that. And they just escrow for that interest rate cap. And at the end of the rainbow, you might have $250,000 instead of it going to the interest rate cap provider.
Like, our inside guy is over at Pensford. I mean, again, big picture, you think interest rates are going to go up and then they're going to stabilize and then they may come back down. I mean, what for your group, again, you guys operate thousands and thousands and thousands of apartment units. I mean, what's your gut telling you? What are you advising your internal people?
Yeah, the house view, I don't know if I'm giving anyone advice, but the house view here, we'll see how smart we are in our benefit of hindsight. But I think we get 150, 200 basis points of short-term rate hikes, things start to break, and then he's got to cut. So I don't know I know Jay Powell is a big fan of Paul Volcker, but I don't know if he's got the stones of Paul Volcker to really, really press it up. I mean, we have a hell of a lot more debt in the system than we did back 40 years ago. So I don't know if he really has the stones to go through, inflict a hell of a lot of pain to the economy. So I think that they'll probably get a couple hundred basis points of hikes in, and then I think we're kind of on the countdown for cuts. That's kind of the house view. So, we were in a similar situation, if you remember, in 2018, Paul. This is kind of my most recent comparison, where the Fed was finally starting to hike rates. I think they got maybe 6 or 7 hikes in over. They got the one hike in, and they sat for a year or two, and then they got 6 or 7 hikes in, kind of culminating towards the end of 2018. We ended up locking a couple deals right at the end of 2018. And I've regretted locking those deals ever since, because then the yield maintenance, skyrockets as the rates plummet, and then you're kind of trapped into these deals. So, if you take a look at this kind of holistically, if you pay an extra couple points in interest expense annually, or you pay an extra few $100,000 and buying a rate cap, still a hell of a lot cheaper than paying, $8 or $9 million in yield maintenance like I have on a deal before. So that's kind of how we're viewing it. I think the flexibility is of utmost importance to us and the way we're looking at it. And so that's kind of my house view around here. And I could be completely wrong. And maybe this is a time we turn into, 1981 and we're going to 20% prime, but I don't think that's going to happen.
So, I mean, you guys keep these properties for a number of years, but some of these syndicators only had them for 2-3 years. James, what's your take? Should you be fixing, floating? I mean, what's your advice to some of these folks these days? And what are you seeing with Fannie Mae and Freddie Mac? Are they doing a lot of purchase acquisition loans? Are they leading the pack?
Yeah, I mean, the whole time we've been talking about guys who already have a deal, right? And their impact. But what about the guys who are trying to buy a deal? They said they were going to they raised $100 million in equity last year, and now they got to go out and buy deals. How are they going to finance these deals? And so, yeah, Mike, when you were talking, I pulled up sort of the federal funds rate from 2018. And so they hiked for 2.5 years, basically from 2017 all the way. They just kept hiking and hiking and hiking until really they sort of hit a wall at probably 2.5%. And then they just cut all the way down to zero. A couple, I think, stats that Pinsford had were usually it's about 2.5 years on average that once from the first rate hike to the first cut. So you've got to hold on for 2.5 years. And if you just signed up a bridge loan right now, then for the next 2.5 years, your interest rate could be going up every month. And I think it's not necessarily that people don't understand the thought process, Mike, in terms of, it's 1% exit, and then I got a 1% interest rate cap as a percentage of my loan. It's just that every month you're getting pounded with this higher monthly payment. And so I think, number one, having the liquidity at the syndication level or at the deal level to make sure you can pay this stuff is number one. And then the second thing is just with the 2-year treasury moving up so much and just sort of that yield curve inverting at some point, probably in the next, 3 to 6 months, at some point that's going to signal a recession. And so I just don't want people to come up 2.5, 3 years from now, your debt's high, we start entering a recession, and then all of a sudden you're like, oh yeah, I got a refi now, right? Because I got a 3-year term. So I would say, even though rates are going up, make sure you hit your rent increases, do your CapEx budget, get that done. And then 18 to 24 months, I'd be calling to get over to a Fannie and Freddie. And Fannie and Freddie are still in business. I mean, they're still going to do 80 billion a year this year, but 80% of their business is refi right now. So they're not doing acquisitions. If they are doing acquisitions, they're at 60% or 55% leverage, but all their business is refi. So as soon as your bridge is ready to go, then I'd be moving over to Fannie and Freddie with sort of a light, either a floating rate or sort of a step down or lighter yield maintenance.
Yeah, I'm not opposed to fixing. I'm just allergic to yield maintenance and defeasance anymore. That's really the lack of flexibility, and yield maintenance and defeasance are a killer. And you're saying that with the hikes, we hiked 250 bips a few years ago, and then they had a cut all the way to zero once COVID hit. When you said we might be inverted the yield curve, well, parts of the curve are already inverted. I'm just looking as we
7 and
talk in
10,
real
yeah,
time.
5
I'm
and
seeing
7, yeah.
the 3-year and the 10-year are the same, and the 5 years higher than the 10-year, the 7 years higher than the 10 years. So it's already inverted. I know the classical definition is more the 2 years above the 10-year, and that kind of triggers a recession. Well, hell, it took 250 basis points and 2 years to get there last time. It took one hike to get there this time. So I know they're saber rattling. They're trying to get inflation under control. This is a different environment than what it was a few years ago, but we also have maybe 8 or 10 billion more in federal debt than we did in 2018 with all the COVID stimulus and some of the crap they passed. So, I think, again, I'm not giving advice. The house view here, Paul, is I think we're just going to hunker down. I think we're going to see some cuts, and those that panic fix for 10-year fixed rate stuff, then I think they're going to be in a world of hurt. So if you are going to fix, maybe try to get a 5 or 7 year, or as Jay mentioned, try to get a step down or some sort of shorter yield maintenance to kind of mitigate the pain. If you're wrong, it's, like I said, we paid a 20-something% prepay on one of our deals. So that's a hell of a lot more than 5 or 10%. That's a huge mistake that we made, and we paid the price.
James, let's go back to, and we'll finish this up in just a second here. Let's just kind of go back to what today is all about. And, there's a lot of syndication models out there. And again, a lot of these syndicators just have not seen interest rates rising. They've been in an environment that interest rates have fallen. Cap rates have always fallen. Values have always gone up. Rents are going up 10, 15% last year. Is that going to be in the future? I don't think so. Tell me the delta between the bridge loan that may get you up to 75% leverage on an acquisition with some loan dollars to do rehab of the property. And then let's say, again, interest rates go up because debt service is now going to go up. Caps have gone up. We just talked about here, flat rents on this deal. And then when you go to refinance or take it out, or if you can't sell it and you have to refinance it into a Fannie Mae loan, you start off at, say, 75 or 80% leverage, and now you're at 55 or 60% because back when you were acquiring the property, that was the highest leverage you can get. I mean, is there something out there that maybe I'm not seeing? How do you not have a capital call on year 3 or year 4 going into this deal?
Yeah, I mean, if you take a $20 million deal, you buying it, Fannie and Freddie will give you $10 million, right? So 50%. You've got a bridge loan to give you 75. That gives you $15 million. But if you take that bridge loan, you're going to probably have to underwrite your starting rate at 4% pretty much. And then if the Fed hikes all the way up to 2%, then all of a sudden you've got a 6% rate. So I think you're going to have to start adjusting your underwriting model to account for that in terms of higher debt service. And then, when you go out to refi, you're probably going to have to use a higher number to refi your number out in terms of, or a higher interest rate to refi yourself out on Fannie and Freddie now. So that's probably on the underwriting side. I think the hard thing for people is just going to be, if you're buying at a 3 to 4 cap right now, it's going to be harder to underwrite, anywhere from 4 to 6% interest rates. So I think you might have a point where some of these sellers are going to be looking at buyers and saying, who's going to flinch first on these prices on these deals? And so you're going to have to definitely get the rents, because you're going to be hit with this, but you're also going to be hit with all the other stuff Mike talked about in terms of property taxes and insurance and that type of stuff.
Mike, what kind of conversations are you having with your property management team on a monthly, weekly basis? I mean, are you trying to whip them as much as possible to get those rents up as high as possible so then you won't have that big impact, whether it's on year 3 or year 4 or year 5 on your deal, or having these immediate reserves that are going to come from your interest rate cap?
Yeah, I mean, what we're still like operationally, I mean, we're pretty full, and the conversation is push harder, right? Like, you haven't found the ceiling yet on rents. I mean, that's, I think it's pretty clear. I was kind of looking just real quickly to record it. I just get these weekly reports every week. So just kind of looking at a couple of our deals here, we're seeing 18.8% last 30-day lease trade outs on new leases on one deal. And Fort Worth, looking at another one here, renewals of 10.6% the last 30 days, new leases at 21.1%. So, I mean, we're seeing numbers like that, Paul. So, I mean, that's going to cover up for a lot of sins as long as these rents keep moving like that. Look at another one, 13% renewal, 22% new lease trade out. So, I mean, we haven't found it. We're just now on the onset of the best part of the leasing season, being in March as we record this. So really it kind of goes from March through June, July, kind of, and probably June, let's call it, in Texas is the absolute best part. And then July and August are decent. And then you kind of seasonally slow down. So, I mean, I think we're going to continue to see some hell of a nice lease trade outs, at least all the way through the leasing season. So we're going to at least have some more revenue to go fight our future problems with, and I haven't seen any capital. So I don't know who's going to flinch first, Paul, to your point, because, it doesn't make a lot of sense when Austin, we had Matt Pohl on, what do you say? Austin, year one, pro forma buyer underwritten, year one stabilized cap, 3.25, 3.5 in Austin. Dallas Fort Worth is pretty much the damn same. So you're talking, and you're in the twos on a kind of historical trailing tax adjusted cap basis. And if you're in the twos and you're paying 4% on your rate to start, it's going to go to 5 or higher. That math, you got to drive these rents or things are going to start breaking. So I don't know what flinches first, Paul. It's a little choppy out there right now.
James, our final question, some of the things that we haven't talked about, what else do you think is important these days for syndicators, buyers of apartments, buyers of commercial real estate? What are, you read a lot of tea leaves and you listen to a lot of podcasts and you listen to, a lot of people that are in the business. What should people know about what's going on right now today?
No, I mean, I think we've covered a lot. I mean, I think it sort of goes back to some of Mike's blocking and tackling in terms of some of these deals people bought in 2020 and now they are 2021 even. And they maybe moved NOI a little bit, but now they're selling it for 20% more. And if you buy a deal now in 2022, don't expect, unless you materially change the deal in terms of pushing rents and getting in there and operating the deal and rehabbing the deal and moving NOI, it's not going to be as easy. And so you're going to have to operate the deal well, execute your CapEx plan. And then some people are concerned about raising too much capital on their deals. They're like, hey, this is going to dilute all the LPs. I don't want to have any excess capital. I would say now's the time to have a little bit more working capital in terms of having some money set aside for whether it's higher supply chain, higher costs because of supply chain, higher interest rate cap costs, having to pay down debt. When you go to refi, I think the syndicators who are going to be around for 5 or 10 years, they're going to raise additional money to make sure that they don't have to have that capital call and go back to LPs and raise additional 50,000, 100,000 a piece 2 years from now.
Yeah, Michael, you were a banker and better known as the crypt keeper, the guy that walked around with a sickle. I've done that too. What saved a lot of people through the last recession or two as a banker? What helped them?
Yeah, the blocking and tackling basic stuff. I mean, make sure you have some extra cash. I think raising the extra few $100,000 to have some working capital, maybe that dilutes your IRR a little bit, having a larger denominator. But if you don't need it, you can always give it back. But if you need it, you need it. And it's hard to go get a second check from some people, especially these larger syndicated deals. And, your partners aren't going to pony you up. You, the sponsor, are the one that's got to step up and solve these problems. So if you're investing with a less well-heeled sponsor, that's a layer of risk that you maybe don't perceive in the deal. Then maybe you should start thinking about, that. I think the other thing, we're in the middle of kind of recapitalizing one of our deals right now, Paul. And, we had an option to get to about 65 with some limited recourse or get to 60 to get non-recourse. And so we had, a relationship with the bank, regional bank. It's on balance sheet. It's a bridge loan. And we're getting a hell of a lot lower rate than what you guys have just been quoting because it's a relationship deal, a little larger size. And we're doing 60 levered, So, I mean, I think I got 40% equity to kind of burn through. And I think we're, getting a reasonable valuation at a lower leverage loan. And we're going to have some cash laying around too, in case something goes wrong that we have it. And, so I think if anything, kind of the public service announcement is you need to start looking at your escrows for rate caps. I think you need to project that your insurance and taxes are going to go up, and Texas will find out taxes here very shortly. And then I think you need to start modeling out higher interest rate expense and kind of look at what your current distribution levels are. And I'm sure a lot of people will be shocked to see that their free cash flow is going to be a hell of a lot less than what they're paying out. You might need to adjust distribution levels before you deplete all your working capital and cause a problem. Because I think these are some headwinds that if you've been in this deal a year or two or three, wind's been kind of at your back for the most part. Now it's kind of getting in our face a little bit. So to be a good steward and protect your nest egg here, you need to start having these types of conversations internally. And maybe, you don't want to disappoint some investors by reducing or eliminating some distributions. But, it's better than going back and asking for a cash call. So you might want to get ahead of this a little bit, would be kind of the main takeaway I want to leave everyone with, at least consider those types of conversations.
Well, as the guy who's has thousands and thousands of investors currently right now, the guy who has thousands of apartment units, are you still thumbs up on multifamily?
Yeah, man, I think the macro is still strong. I mean, I think there's it's a competing mindset. You're looking at Ukraine and Russia, and you're looking at the inflation, and then you're looking at interest rates going up and taxes and all the input costs going up. So that's kind of your negative camp. And then the positive camp, I mean, you still got, historically outsized rental rate growth numbers, and your revenue usually, for every dollar of revenue, you have 50 cents in expenses in the business, and our rents are going up like crazy. So, it's driving our net operating income, and reasonably think that that's going to continue to a certain extent. I don't think we can necessarily bank on hitting, 15, 20% for an extended period of time, but we've been there for about a year now. So I don't see what's going to stop it in the near term. And then, I think you got the in-migration. I think in Texas, short of the Austin MSA, you've seen a pullback in supply from historical numbers. So you have more people moving in than probably historically on average. You have less supply than on average. You're seeing the rents go up, probably partly due to that fact. And, you're seeing people flee these higher tax markets, and they're coming to the Sun Belt. And it seems like it's not like as my buddy Al Silva, our joint buddy Al Silva said, it's not like a cyclical thing. This is a secular shift that we're just kind of in the middle of. It's a generational thing that's got, decades of legs to it. We've been in it for a while. We're going to be in it for a while. And if we're seeing higher home prices and higher mortgage rates, makes home affordability even tougher, which keeps people in the rental pool, which drives rents up. So there's a lot of good things, and I think we're still thumbs up. I think it's just about mitigating some of the risk in this in the short to intermediate term. Buying smart, having a good capital plan in place, don't get over levered, have some money set aside, and you can come out the back end happy that you bought.
I certainly hope that people take your public service announcement to heart, and in the hands of this big ship that Michael Becker has control of. Hopefully the passengers feel safe and they're ready for the ride down in the ocean here. So I think that's great. So good information. Michael, if you could talk a little bit about SPI again, what do you guys do? And tell us a little bit about what SPI is.
Yeah, the easiest way to find out more information about us is just go to our website, which is www.spiadvisory.com. We updated it several months ago. So it actually has some actual useful information, Paul, where it was kind of crappy before. So we got a pretty good website, describes it. But basically, we try to find high quality opportunities, something that's kind of a relative value to current market, something that we think is kind of mispriced, put them together and go out and raise capital. From a lot of people off this podcast actually have reached out to us and invested with us. So appreciate everyone that has done that. So yes, go to our website, fill our kind of informational format. We'll get you into the database and put future opportunities in front of you.
That's great. Great information. James, any final words before we say goodbye?
No, I think we're a little jaded because we've been in this business for a couple of years and we've just seen it go up and up and up and up. And we've heard the pitch on why multifamily so many times that we sometimes forget it. So thank you for the reminder, Mike. And we're in the weeds of this thing and we get into it. So hopefully today's podcast doesn't scare anybody, but just be aware of what's out there.
Put your money with good operators, put your money with people that know what the heck they're doing. And we certainly do appreciate James Zhang and Michael Becker. Thanks for coming on board and listening to Ask Mike Mondays. Again, I'm Paul Peebles. Have a great day.